Should you invest in gold or should you invest in real estate? Or what are the differences between investing in gold and investing in real estate? My name's Hugh Chen. I'm in commercial real estate for the last 25 years and own and invest in commercial real estate. And I'll tell you the difference between investing in commercial real estate versus investing in gold from firsthand experience. So I'm going to be sharing some lived experiences. So we analyzed the first 10 funds that we launched. Let me do a share screen actually. Here we go. So the numbers that you're seeing here are from actual K1s. The the last time we were able to issue K1s was for tax year 2024 because 2025 just ended, so our K1s won't be issued for a couple months. And I wanted to give you very accurate numbers. So these are actual performance, not projected or assumptions or anything like that. And then I cross-referenced it with the price of gold at the time that we launched each of these funds. And if we were to put an equivalent amount into gold as opposed to the commercial real estate that we ended up investing in. And let me walk you through it. So the first 10 funds are Central Plaza, that was a single property fund in St. Petersburg, Florida. It's a shopping center on Central Avenue, and we actually sold that one back in 2023 to a multifamily developer. So hopefully they're able to repurpose that property to mixed use. This is in a great corridor. And SunPoint is another single property investment that we made around the same time as Central Plaza. Both we acquired in 2014. And SunPoint we still own today. We refied it a couple of times. We've given back all of the equity to the investors, and we still own the property, and it still cash flows very nicely. Seminole Heights Plaza is a property we bought in 2015 that we still own today. Similarly, to SunPoint, we refinanced that property, gave back the equity to the investors, and are doing great with that investment. It's in Tampa, Florida. SunPoint's also in the Tampa, Florida market. Beauclair Village is in Jacksonville. We acquired that property in 2016, and that property is getting repositioned right now. It had Big Lots in it, and that Big Lots left, but we're replacing it with a really good credit tenant paying significantly more than what Big Lots was paying because Big Lots locked in that rent back in the 80s or 90s. And we're marking it to the market rent today, which is significantly higher than what it was back in 1990. Shops of Armenia is a property that we bought in 2016. We actually sold that one back in 2019, and that's in the Tampa market. Lantana Village Square is a property we bought in 2017. We sold that in 2023 to a multifamily developer, and that one we did fairly well in. Jack's SDC, that's a two-property portfolio of two shopping centers in Jacksonville. And by the way, this column here, you'll see, the number of tenants. So for Jack's SDC, it's two properties with 26 tenants in total, 146,000 square feet of gross leasable area. We bought that one in 2017. And for the analysis, just to kind of make sure we're getting whole tax years and whole calendar years, we're comparing it based upon the end of the year of the last K1 that we received, which is for tax year 2024. And so 2025 will be coming out in a few months. South Bay Dunn SDC, this is a two-property portfolio, 37 tenants, and one property is South Bay Plazas in Tampa. The other one, Dunn Village, is in Jacksonville. And we bought both properties in 2017, and we still own them today. We refinanced both properties, gave back the equity, still own the property, and it cash flows nicely. 2019 SDC is a three-property portfolio with 83 tenants. We bought those properties in 2019. We still own them today. And one's in the Atlanta market, one is in Kissimmee, and one is in Orlando. And 2021 SDC is a six-property portfolio that we acquired around 2021. and has 171 tenants, and we still own that today. And just to give you an idea, the purchase price cap rate on average is here based on the going in NOI and the price that we paid for the property. So in this analysis, I'm assuming that, just so that I'm not giving more weight to any one of the investments, what if there was a actual investor that invested about 2% in all of the funds equally? So for example, at Central Plaza, we raised $3.2 million to buy that property, and we also got a loan. So 3.2 was the down payment plus the cash reserves and the transaction costs. So that would mean that we would have invested $63,042 in this example. And similarly, for our last fund, we raised $40 million, and 2% of that would have been $788,000 and change. And so this is just equally 2% in each of these funds, right? Now, if you go over here, and I'm just going to focus on gold because I have a more comprehensive video talking about stocks and bonds and everything else, but more broadly. So I'm going to just dial in on gold. On the date that we acquired Central Plaza, which is March of 2014, the price of gold was $1,321 an ounce. And on the day that we sold the property, which is in March of 2023, the price of gold was $1,994 per ounce. So you can see that the IRR of holding the gold, even though it appreciated, significantly from 2014 to 2023, that's over 9 years. So if you do the IRR, the internal rate of return, or the XIRR, which counts it by the month, it's a more exact method of internal rate of return, you're at 4.7% IRR. And if you do that similarly with Sunpoint, which is a property that we bought in 2014 and we still own today, the price of gold at the time that we bought the property was $1,272, and the price of gold December 31st, 2024 is $2,625, which is a huge increase, right? It more than doubled, but it's over a 9-year period. And so that's a 7.1% IRR when you do the calculation and smooth it out over the 9 years. And similarly, you have let's look at Jax. So Jax, we both of these properties we bought in 2017, and the price of gold at that time was $1,200, and today, we're actually December 31st, 2024, $2,625. And I know that you're going to say, hey, the price of gold went up a lot from December 31st, 2024 till today. And that's true. I think that the price of gold is much higher today. That being said, the value of these properties have also significantly increased since the last time we acquired properties, which is in 2021, or the last time we launched the fund at least. In 2021, remember, during the COVID, nowadays retail strip centers are one of the most desired asset classes in the commercial real estate space. So it's a much different world even from 2021 till today. And if you were to take the weighted average of the gold in 10 deployments from 2014 to 2024, and you did the weighted average and you put in the exact same amount you would have put in to the commercial real estate, right? You're looking at a weighted average IRR of 11.1%. We raised $86,291,900 over those 10 funds from 2014 to 2021, not including anything we're doing currently. And 2% of that, in this analysis, just to keep everything weighted equally, is $1.7 million, right? So if we invested $1.7 million in gold instead over those same 10 deployment times, 2014, 2015, 2016, 17, 19, 20, 21, then for gold, as I stated, it's 11.1% IRR weighted, and then for real estate, we are looking at a weighted average IRR of 15.5%. And so the properties that we already sold. And so those values have already been locked in. The properties we hadn't sold, we're using a very conservative exit cap rate, 8%, 7.3%, because it's in Florida and it's a nice property. And so we're not using 6% cap rates or even a 7% cap rate. Some are in the mid sevens, some are in the low sevens, and the low sevens. Frankly, this 7.3 is based on an appraisal, so it's there's backing behind it, right? And so the weighted average cap rate is 8.1% exit, because that's where a lot of syndicators and a lot of fundraisers can really, I guess, manufacture higher, but on paper returns is the exit cap rate. We're being very conservative here, and you're at 15.5%. And you might be wondering, hey, what's going on? Gold went up from $1,200 to $2,600 over that time period. And why is it that why is it that real estate has outperformed so much? And there's a couple of reasons. First, you have to go back to the ideal investment framework. I is income. Gold doesn't produce any income. If all of the commercial real estate investments, they're throwing off cash every single quarter. So in some cases, they're throwing off 10, 12, 14% cash on cash. In some cases, we return all of the equity by refinancing it, and now the equity's been returned, but they're still getting quarterly distributions. And that goes to L in ideal investment leverage, right? You can actually put leverage on commercial real estate because it produces income. It has an ability to service the debt, right? When you borrow money, there's a payment every month, and you need assets that produce income to be able to service that debt, to pay that debt. And gold doesn't really generate income, but commercial real estate does. And so that's the leverage that we're able to do. And by the way, our blended leverage going in to all of these properties was probably 60 to 65% loan to value. So not even high leverage. It's not like a house where you're leveraging 80% LTV. These commercial properties are 65% on the high end, and in some cases 60 or even lower percent. Now the blended average now, I think, is in the now ideal. So I is income, D is depreciation. I'm not even taking depreciation into account. You can't depreciate gold because the IRS doesn't allow you to do that, but you can depreciate commercial real estate, and we do an accelerated depreciation. So just to give you an example, for those 10 deployments, those 10 funds that we raised, the total distributions, and mind you, these are Sun Point is still going, and that's a 10 years of cash flow, but 2021 SDC in this analysis, you only had a partial year 2021, full year 22, full year 23, and full year 24, right? But in any case, we received 1.4 million of distributions off of our 1.7 million of investment in this scenario, right? 1.97% ownership. So that's how much was paid to you over those 10 years, $1.424 million. But because you're able to take advantage of the depreciation mechanism, and accelerated depreciation, we offset that 1.424 million of income, right, with a depreciation of $1.334 million, meaning that even though you're distributed $1.424 million, you paid income on $132,000. And that's just the way that the depreciation works. Now there's catch-up depreciation later because we're doing accelerated depreciation, but from a time value standpoint, it's much better to do it this way. And then the E is for equity in ideal investments, right? With gold, you can increase equity, right? As the price of gold goes up, then your equity in your gold investment also goes up because the price went up. There's no leverage, it just goes up. Same thing with the, well, similarly, but even better in commercial real estate is that, yeah, the value of the real estate can go up, so your equity can go up. But also as you're paying your principal balance down, because the tenants, as they're paying rent, you're using those rent payments to pay the mortgage, and part of the mortgage is a principal pay down. You're increasing your equity through the principal pay down every single month. And so that's also a reason, right? You don't have that advantage, the principal pay down as a function of leverage using gold. And then the appreciation, gold certainly appreciates. You could see that. And so does commercial real estate. The difference would be that with gold, you have to wait for macroeconomic factors to happen. You personally, or me personally, I can't make gold appreciate because I do something to it, right? You can argue, yeah, maybe you can make jewelry or something, but I'm talking about gold as a commodity, not gold as jewelry. I can make my commercial real estate appreciate in value, specifically strip centers, for a host of reasons. Number one, I can increase the rents because maybe I bought the properties at a very below market rent because the rent was set in the 1980s or 90s because there's really long-term leases. And then I was able to reset the rents to market because market's much better. And maybe the Tampa market or the Jacksonville market or certainly the South Florida and Orlando markets and Atlanta markets are much better than 20 years ago. I'm able to increase those rents. Also, I can increase the quality of the tenants, which decreases the cap rate, right? So if you do both of those things, you can force some appreciation. And then, and I already touched upon the leverage part of it before, that gold doesn't have it. So when you're comparing it to my lived experience, which is through these 10 funds, and if I didn't mention it before, so I'm president of Saglo companies. We own and operate shopping centers across the Southeast, and I was directly involved in buying all of these properties, raising the funds, and finding the loans. I'm actually personally involved in all of these, and I have more than $1.7 million in invested in all of these properties, actually. So that is the so I'm talking from a firsthand experience, from a lived experience, and wanted to just kind of walk you through the difference between gold and investing in commercial real estate. And you can see that we actually did a similar exercise with stock indexes with the S&P 500 and the Dow Jones and the Russell 2000. And I'll go over that in a separate video because this video is already getting fairly long. But I wanted to show you, investing in private placement commercial real estate versus just buying gold. The disadvantage of private placement commercial real estate is obviously the liquidity. You can sell gold at any time. It's a very liquid asset. For private placements, these are long-term holds. You're only going in here if you want long-term cash flow and also you want the depreciation benefit. If those things don't really matter to you, you might be better off buying gold or stick with stocks or REITs. But that's what I have to say. Hope you enjoyed it. Comment below and let me know. I'm actually going to link my video on the larger video on the ideal investment that kind of goes over the IDEAL concept a little bit more. Comment below if you feel that what I said makes any sense at all or if you disagree. Thank you.